Today, I'll be breaking down Tesla's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Tesla's growth story is nothing short of remarkable. Over the last decade, the company achieved an astounding 4,664.1% increase in revenue, with an impressive annual average growth rate of 47.2%. Even more fascinating is the financial turnaround, transforming a negative EPS of -4 cents a decade ago into a robust $3.10 over the last 12 months. Free cash flows had also a great turnaround from negative $86.97 million to $1.97 billion. Now, let's shift gears to profitability dimension. Averaging a gross margin of 22.0% over the past 10 years, Tesla's current margin stands at 19.8%. Operating margin, once a challenge with a 10-year average of -0.4%, has surged to an impressive 11.2%. The free cash flow margin averaged -13.8% over the last 10 years, and the current value sits at 2.1%. Finally, the return on invested capital averaged 2.9% over the last decade, and the current value is an outstanding 24.7%. Moving on to the solvency dimension. The debt-to-equity ratio 10-year average is 1.35, with the current value dropping to 0.15. Additionally, Tesla has more cash than debt. All indicators of solvency paint a picture of a company with a resilient financial position. Now the important fourth dimension, valuation. The first ratio we look at is enterprise value to sales. Since the 10-year average is 9.31x and the current ratio is 8.43x, this implies a potential undervaluation for Tesla. The current value and the 10-year average of the price-to-earnings ratio are 76.65x and 358.61x, respectively. This implies that Tesla is undervalued despite the high multiple. The fifth and last dimension is the shareholders' return. Since Tesla doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio are naturally rated 1. The key metric of shares outstanding indicates that Tesla has been diluting its shareholders over this 10-year period, with a whopping increase of 94.3% on the number of shares outstanding. That's something an investor wants to run away. However, over the recent years, the dilution pace came to a stop. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this 5-dimension section. Now let's move on to Tesla's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Tesla's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Tesla's stock fair value at $162.52, 31.6% below the current stock price, which indicates that the stock is overvalued. The bull case prices Tesla's stock fair value at $256.62, 8.1% above the current stock price, which indicates that the stock is undervalued. Finally, the bear case prices Tesla's stock fair value at $94.47, 60.2% below the current stock price, which indicates that the stock is overvalued. In summary, Tesla earns a solid 5D rating of 3.3, and its weighted average price target is $167.73, implies a 29.4% overvaluation. Putting all together, my final verdict is, next round, analysis 2.0. Despite the apparent overvaluation, Tesla is a great business that I want to deeply analyze and understand if I'm not underestimating its potential. Stay tuned for the next analysis.